Welcome back. In this video, we'll explain how to use moving averages in technical analysis. By the end of this video, you'll understand the different types of moving averages and how they help identify trends. Moving averages smooth out price data to identify trends and potential entry and exit points. The two main types are simple moving averages, SMA, and exponential moving averages, EMA. An SMA calculates the average price over a specific period, while an EMA gives more weight to recent prices, making it more responsive to current market conditions. Moving averages are used to identify trend direction and potential support and resistance levels. Common strategies include using crossovers to different moving averages to signal buy or sell opportunities. Imagine you're analyzing a stock and notice the 50-day SMA crossing above the 200-day SMA. A bullish signal known as the golden cross. You use this information to decide whether to buy the stock. Think of moving averages like a GPS system. Just as a GPS helps you navigate by smoothing out your route, moving averages help you identify market trends by smoothing out price data. In summary, moving averages help identify market trends and potential trading opportunities. Stay tuned for our next series of videos as we continue to explore stock analysis techniques.